On that thought, on behalf of ISC, I thank you all for your time. And now hand it over to my colleague Shreya from Team ISC to take your day ahead.
Thank you.
Thank you. Thank you, Neha. Hello all and welcome to the session. At present, in parallel to this session, we have a panel discussion on Patient Start, the power of grant capital in incubating disruptive climate innovations. That is going on in the Audi 2. Please feel free to move between Audis and attend the discussion of your choice. Thank you. So the stellar panel with us here in Audi 1 will throw light on other innovative modes of financing climate tech startups in India, that is going beyond equity. Without further ado, let me briefly introduce you to the panel. First, we have with us Mr. Abhishek Gupta, Investment Director, Caspian Investment Advisors. Caspian is one of India's oldest Indian impact investors and the first to be granted B Corp certification. Through both debt and equity, they enable the growth of enterprises that work towards creating social and/or environmental impact. Our next panelist is Mr. Biswaroop Banerjee, Program Manager, IKEA Foundation. IKEA Foundation, through their strong presence across the global south, is committed to tackling some of root causes of inequality, poverty, climate change, and lack of resources such as clean air, energy, and fertile land. Our third panelist is Mr. Jayant Prasad, Executive Director, Seekers Finance. Seekers Finance is a specialized sustainable energy finance company that operates in the rapidly growing segments around clean energy and energy efficiency. Launched in 2016, it is developing new instruments for project finance and decentralized renewable energy, creating standards for sustainable energy bonds and building data around risk metrics. Finally, we have with us Mr. Manish Chaurasia, MD, Tata Cleantech. Tata Cleantech Capital is a joint venture between Tata Capital Limited and IFC. They are registered with the RBI and offer end-to-end business solutions in clean technology and infrastructure space. This discussion will be moderated by Ms. Bama Balakrishnan, CEO of Northern Arc. Northern Arc is a financial services platform set up primarily with the mission of catering to diverse credit requirements of the underserved households and businesses by providing efficient and reliable access to debt finance. Once again, a very warm welcome to all the panelists. Over to you, Bama, to take this session forward.
Thanks a lot, Shreya. It's a privilege to be moderating, as you said, a stellar panel today, and a lot of familiar faces here, people I've had the good fortune of working with in the past. Certainly looking forward to a very engaging and inspiring discussion today. While we've had an introduction to each of them and their organizations, might I thought be interesting for the audience to hear from each of you, maybe just for a minute, on what you've been looking at, particularly in terms of climate tech more recently in your respective organizations and the spaces that you address. If I can request Abhishek to start and move forward.
Thank you, Bama, and good evening, everybody. So Caspian debt that I look at is the debt business of Caspian that I look up, and Caspian debt is a multi-sector debt provider. We provide debt financing of up to $2 million across sectors like clean energy, energy efficiency, sustainable agriculture, healthcare, education, water and sanitation, and so on, and of course, financial inclusion. As far as the clean technologies or climate technology space is concerned, we have funded about 30 startups and social enterprises. So that's 30 startups and social enterprises that work in the climate technology space with an average, a typical loan size or a debt financing size of about $500,000 US. And we've done a total funding only in the climate technology space of about, I guess, about $30 million US. So that's broadly what we've been looking at Caspian Debt.
Thanks, Abhishek. Biswaroop, if you could kind of jump in and give us, like, I guess you would have a slightly different take on what you do by way of intervention in this space.
Sure, thank you. In fact, with IKEA Foundation, it's a purely grant-making organization, and we are working in the intersection of poverty and climate. And we have a mandate of, we normally work with most international NGOs and NGOs, and as well as the UN agencies. As I highlighted, like climate and poverty are the two major investment areas for the foundation, which is looking in the long run to invest more than so far we have done around 2 billion of philanthropic investment. But in other spaces now, moving forward, I think we have a commitment till 2025 to invest in further 2 billion euros in these two spaces. So yeah, so as we move in the climate space, we realize the importance of working more, engaging more with the private sector as well, and that's where blended finance as an instrument is gaining importance slowly for us as a portfolio, and we are also looking at that's how we are diversifying into more kind of partnerships with financial institutions and intermediaries beyond the non-profit world that we have been working so far. So I'll pause here. Maybe I'll be happy to elaborate further down the discussion.
No, indeed, Biswarup, I think specifically your comments on how you look at blended finance as a tool, I think would be truly valuable for the wider group. Jayant, as someone who's promoted an organization focused on this space largely, would be great to hear what you're seeing specifically in terms of your area of focus recently.
Sure. Thanks, Bama, and happy to be here. As you've colored, Seekers is set up as an NBFC exclusively focused on sustainability financing. Within that, we have been working actively on what we call distributed solutions for sustainable energy, in which we are excited. We think there's a lot of scope to support the sustainability transition or the clean energy transition for India. We've worked across sectors, whether it is rooftop, energy access, energy efficiency, electric mobility. We would have funded more than 50 megawatts of distributed rooftop. We would have funded more than 3,000 electric vehicles and already, and we are building on that. We, however, are also looking at areas like water, waste, because we are the overall area around how India as a consuming economy, where almost 2/3 of the demand over the next 20 years is not yet set in. How does it transition at an early enough stage to different modes of, to more sustainable modes of consumption? How do we catalyze that? That's what, keeps us going and keeps us excited.
Interesting. Very interesting. And I think the point I'm going to come back to probably you and Abhishek later in the conversation, just, wearing my Northern Arc hat, is to say what will it take for organizations such as yourself to catapult what you're doing significantly more, and what kind of market linkages might help. If you're sort of playing an apex role in understanding the space and working with these entities, how does one make sure we multiply your power? But we'll probably pick that up when we come to the capital markets and debt solutions segment. Manish, coming to you, I was quite intrigued by the breadth of work that Tata Cleantech Capital does in this space, and I'm sure the scale of work that you're doing is significantly higher than perhaps a lot of what a number of others on this panel are addressing. But that gives us the benefit of your vantage view of the ecosystem. So would be great to hear what you're seeing and what you're working on more recently.
Sure. So thanks, Bama. Tata Cleantech Capital is a green investment bank. In fact, the first private sector green investment bank in the world. And we are part of the green banking network. As part of our mandate, we are mainly into climate finance. And we look at both the utility scale projects, which are of course much bigger projects in the renewables, in water, in electric mobility, and so on and so forth. We also look at smaller projects under our new initiatives division, where we are doing projects under solar rooftop, some projects under energy efficiency by way of helping ESCOs to fund their operations. We're also looking at projects in smart meters and so on and so forth. So that is very briefly about us. We have funded more than 250 projects, and we are about 6 years old. Yeah.
Thank you, Manish. I think to kick off the conversation, broadly we have three segments that we're going to speak about, and hopefully leave about 10-15 minutes for Q&A. I think the first was to kind of get a sense of what the climate tech landscape looks like, particularly from the perspective of startups in the space. So, Jayant, if I can request you to maybe start painting the landscape for us,
Sure.
that would be great.
Sure, Bama. I mean, at this stage, when we are looking at the climate tech landscape in India, I mean, it's not an overstatement to say we find that the situation is fairly exciting. What we see is there are a fairly large number of entrepreneurial organizations working on adapting technology for the Indian context, working on new business models, and we see a lot of this translating into not just large scale municipal or utility projects, but the solution multiplicity is astounding. In fact, that's what drove us to this segment in the first place, because we saw that it was not one monolith solution, right? That set up x thousand megawatt thermal power plants and then your problem is solved. We saw that the way the transition was happening was beyond conventional conventional infra imagining. But at the same time, a lot of these segments had applications which could scale from an individual household to a factory, to a school, to a industry, or even work across shared solutions. Like, somebody else owns the asset, somebody else owns the charging, somebody else owns the battery kind of solutions. And we think this is something which will happen over the next couple of decades as globally technology evolves. India is going to lead in evolving business models which work for mid of the pyramid and bottom of the pyramid. And that's where we think as a early entrant into this, right? I mean, we are all young organizations here, whether it's Caspian or Tata Cleantech or us. As early entrants, we sort of want to stay ahead of the pack in terms of understanding how this works. And it's also, on the other hand, it's not all excitement. It's not that every segment has seen equal excitement all the time. Something catches the fancy of the market today, something may be equally exciting to me, but it catches the fancy of the market 3 years later or 4 years later, right? So there is a bit of hype cycle with stuff, and there is a bit of reality checking with stuff, right? So we have to blend these two. How do we look at the fact that there is so much demand coming and there's so many multiplicity of solutions coming at the same time? How do we have a sense of realism around it? Because we are doing debt, we are not doing equity, right? So we want to be sure that we are able to see that. So I'm just going to pause there.
No, that's well put, Jain, especially in the context of where our markets are today. Yes, indeed, some of us are in the business of debt. Abhishek, having looked at some of these entities from a financing perspective, what's your sense on the breadth of entities that look like they're bankable? You'd see them scaling up. You would see other investors coming in, working with them. And so on. The ticket sizes that you spoke about were small, but certainly looks like it's an interesting space if you've already done a large number of transactions there. So your perspective on this?
Yeah, so I think one of the very interesting things that, I mentioned that we funded about 30 companies. And the interesting thing is that if you kind of split them according to the business models, you will find about 11 to 12 different business models or products that we are talking about. So it's a huge variety. So that's number one. So unlike, whenever we traditionally talk about clean technologies, you see a huge ground-mounted solar panels. Unfortunately, in our world, it's completely different. It's a mix of a variety of things. Of course, the solar panels also do exist, but you have things like mobility, of course, and beyond that, energy access solutions or clean technology solutions that work at the intersection of food and agri and clean technology. Or you have energy efficient applications, say energy efficient fans, or even products that reduce energy consumption in buildings. For that, we've also got for example, products that reduce the use of chemicals and hence lead to reduction of pollution. So from the perspective of business models, we've seen a very wide variety of business models. One of the disappointments that we as a lender had very early on, in fact, when we started off looking at clean technologies or clean energy as one of our primary areas of focus a few years ago, having coming from an impact investing background, we wanted to focus on the intersection of low income and clean technologies, and we unfortunately did not find too many debt ready companies at that point of time. So we had to kind of switch or shift focus slightly to some of the other things that I mentioned, where a lot of the companies were essentially not directly dealing with the lower income household, but were essentially solving the problem of climate from a long term perspective by reducing, for example, energy consumption that ultimately leads to pollution at some stage or the other. One of the other realizations that we've had from a financing perspective is that, again, this comes from our lens of wanting to work in high impact sectors. We realize that when you want to work in that area, a lot of the projects have a kind of a direct or indirect dependence on government funded either subsidies or government promoted projects. And very unfortunately, we realize that even though it looks like a solid thing to finance from a debt perspective, it may not always be a good idea if the entire dependence is on government projects. So where we found opportunities of financing, for us at least, is that we look for a decent blend of B2B and B2G for that matter. We have found a few cases where B2C companies also exist, but I would say significant majority of our companies are B2B, and that actually makes it easier for us to finance from a debt perspective, at least we do it. But all in all, I would say there's a wide variety of types of companies. The debt requirements in each case may be small. So we've started off with companies with loans as low as 10 million Indian rupees and sometimes even lower. But what has happened with a lot of those companies, it has gone up. We've gone all the way up to 2 million US dollars. And what has also happened is we know that only us can't provide the entire financing requirement. So wherever possible, we've encouraged other lenders or debt financiers to come in. Unfortunately, banks are still not forthcoming. It's basically the likes of Giant and other NBFCs who understand the bits and pieces of this who have tried to come in. But I would still say that access to financing for these kind of innovative enterprises is still not there. We really need more people, or people like us need to be able to provide different versions of the product that we can offer. So I think that's what I would say.
That resonates a lot, Abhishek. I mean, I think if we reflect back to the journey of how financial inclusion actually started in India, and at the very early stage, I think a lot of the entities were very small, looking for small ticket financing, but still not really very well understood by large financial institutions. Some of it is true even today. But it's just that the ecosystem has grown larger, more mature, and I guess there is a cycle to it. But I think I completely appreciate what you're saying on the catalytic role that players such as you, Seekers, and at a larger scale, Tata's play. I think that's something that is very, very valuable. If we can kind of get into one of the key topics, which is to say, what are the kind of financing solutions that some of these climate tech startups in particular look for? And Jayant, if I can request you to kind of maybe break down the capital structure for us and tell us where do you see the bigger gaps? So is it the plain debt? Is it more of blended finance that's required, a combination? And what kind of solutions you think would be required? And I'll after that we would love to hear from Manish on how he sees the cycle kind of maturing as entities grow larger. What kind of other solutions come in?
Sure. Thanks, Vama. This, from my side, the answer has two parts. One is to look at the need of the enterprise, and the second is to look at where the gaps exist, right? Because both have to be understood distinctly. So when we look at enterprises, when they come to us, right, they're typically using equity to either prove their technology mastery or to incubate or create their business model, right? And they need to reach unit economics or break even level, and for that the equity role is vital, right? The second part is when they are looking for debt, they are looking at debt to help them execute orders, right? So working capital. They are looking at debt to help them deploy assets, and certain kind of assets can be short duration. I think we heard the earlier panel talking about electric vehicles being funded for 3 years. Could it be funded for 5 years? You try and fund solar for 3 years, it doesn't work, right? So some of them are short duration friendly, some of them need long duration financing, right? But what people don't realize is a lot of the debt going for climate transition actually has more infra like returns, right? So compared to other segments which are SDG aligned, where you're targeting new to credit, bottom up pyramid, the debt here, unless it is mixed or overlapping with a new to credit segment, let's say you're trying to finance an e-rickshaw driver at the simultaneously that person is new to credit and daily income earner, right? Except for segments like that, most of the segments will return to you long duration infra like returns, and that's the nature of debt, right? To help execute assets and execute orders and deploy assets. Now, when we look at gaps, what we see, and this we see for organizations which we are funding or evaluating, there is a significant friendliness in the market for what we call seed money. Though globally that will not be called seed, that is angel or even pre-angel, right? So that is available. And then there is a huge vacuum till you reached what is called growth capital, right? So somewhere between 3 million and 50 million, there is a black hole in equity. And a lot of the equity which is trying to come in is usually saying, hey, give me something which is deep tech rather than asset deployment, right? So these are the two sort of gaps we see. It's a very unfriendly market for something which is not positioned as deep tech, or something which is not is wanting to grow in increments from 500,000, 3 million, 10 million, 25 million, 50 million, right? There are companies which have jumped from like 3 million to 50 million, or 7 million to 50 million. It's ridiculous. I mean, nowhere in the world that happens, but that's a gap which is there in the climate tech market in India, in the equity side. And that stalls companies. We see companies stall because of that, because they've reached there and then they're like, struggling, and then they become stale. So the equity market says, hey, this company is passe, I mean, this opportunity is passe, or maybe this segment is passe. When we go to the debt side, the gaps which we see, as I mentioned earlier, is if you're looking at investors who are ready to fund new segments, they want to start funding new to credit kind of yields. So you lend at 25%, I will lend you at 15%, which is, let's say, 10% in dollar terms, right? But if you're saying, hey, this is not the rate which this kind of debt can absorb, the question is, oh, maybe it's not viable. Why would you call a 25-year asset, which is giving annuity income returns, not viable because it is being priced or it can absorb debt at 10%, right? That's counterintuitive, but that's the catch. So you have some amount of debt available, which is high yield. Moment you want to transition that to asset owning, you need to work down the risk platforms and the aggregation stack so that starts accessing it, and then again a vacuum opens up. So the mainstream market or the large, I mean, Abhishek talked about banks being reluctant, but from the bank's perspective, they're like, if this was $100 million deal or a $50 million deal, happy to do it. And this is the rate, and hey, that rate makes sense, whether it is from the Indian context or global context. But you're trying and transitioning someone from a 500,000 debt or 1 million debt or 2 million debt to that. In between, there is a big fall off, right? So, and that's where I think some solutions, not all, come from blended finance, whether you're trying to subsidize or help the organization prove its technology, prove its business model, reduce its cost of debt capital, de-risk some of the debt portfolios, right? And I think amongst all 4 or 5 lenders out here, I think we have used one or more of those. Whether that is necessary, yes. Whether what is available is sufficient, I think we will discuss later in the panel. I have my views, I will share them. But I think that's the way we see the landscape.
Oh, very interesting, Jayant. I think I never quite thought of it this way, to say that the returns in a sense act as a constraint for the kind of debt that you can attract in the segment. And perhaps there is also a risk perception issue in terms of the breakdown of the kind of risks these institutions have in their life cycle, and what kind of capital can fund or mitigate what kind of risk in their capital structure. And we'll come back to the point on blended finance. We'll get Biswa to kind of comment on that as well. But Manish, if you can give us a perspective from the kind of organizations and projects that you look at, and perhaps address, I would say, a couple of points that came through. One, Abhishek's point of saying that they're unable to look at the intersection of how some of these companies or these initiatives impact mass market, or the low income kind of segment which they are keen to support through these initiatives. And if you've seen scalable models that make that possible, that's one. And the other question I was wondering about is, are there larger organizations that you look at, or initiatives you look at, which are basically linkages for some of the startups that Abhishek and Jayant would perhaps be evaluating? And is there do you see gaps in that ecosystem? And what have you seen as evolving structures for the larger organizations? Maybe there are learnings for what we can do for the smaller ones from that.
Yeah. So very pertinent question, Bama, and I completely agree with what Jayant said and Abhishek said. So as Jayant said that, you have companies, they start and they reach certain scale, maybe 5 million, 10 million, and then they realize that now they have to actually jump to 50 million. There is nothing in between. Now, if you really dissect this sector, number of companies deal in those projects where the counterparty risk is extremely important, and the enforceability of contract is very important. For example, I know a few companies who provide smart meter solutions. So technically they have mastered their work, but then eventually they have to get a contract from a state electricity board, and their payment comes from a state electricity board, and that state electricity board has to honor the contract, pay in time, and maybe pay whatever is the penalties and so on and so forth. So if you take service-based companies, this is one example, smart meter, then there are solutions or energy efficiency solutions for buildings and all. So there typically the risk actually for a lender goes up significantly, because one, there is a technology risk. The other is there is a very huge contract risk. And unfortunately, in the emerging economies like India, the enforceability of contract is not that strong. So actually it multiplies the risk. Then if you see most of these clean tech technologies, normally they have very high upfront cost. And after that, the operating cost is very low. And the total cost of ownership is actually much more competitive. But the challenge is that the initial funding amounts are high. And as Jen said, the debt required is also for a very long tenor. And all this has its own complexity. For a bank, it is easy to do those projects which are less complex and provide more stable returns. Now here you have a project which is far more complex, and the contracts are still evolving. So these are the practical difficulties. But at the same time, I also see this as an opportunity. Because of the fact that if you see the ecosystem, multilateral institutions, other climate investors are part of this. And they are actually very keen to fund projects in India, because India is playing such an important role in fighting this global warming. So if you can collaborate with them, which is what we have been trying to do through various blended finance products, it can be first loss guarantee, or it can be a very long-term loan, or it can be a low-cost loan. And then you have to work along with your client. So you have to work along with the client. Sometimes you have to also work along with the counterparties and try to build a product which is bankable. So that means working on the contracts. So if I take this further, I can take an example of a solar rooftop project. So what we have done sometime is that a client has come to us saying that, hey, I've got this 5 off-takers and I want to take funding from you for a solar rooftop. So the important thing is that one has to study the contract, and if the contract has weakness, then interact with the client and see how that contract can be improved. Then one has to go a little further. Now technologies in solar rooftop are evolving. A few years back, we used to have polycrystalline panels. Now we have monochrome panels, or monocrystalline panels, which are more efficient. Now we have got plastic, which is much more efficient, which can further increase the efficiency. So the thing is that it is possible that if you are having relationship with various ecosystems in the market, then you can develop that market. So basically, to really make things change, important thing is the collaboration between various players in the ecosystem. One is, the climate financier has to take the lead, but then he has to work along with the off-taker, he has to work along with the developer, he has to work along with the multilateral agency and come up with solutions. So that is the way I can see that solutions can emerge. Now, as far as we are concerned, we have seen the solutions emerging in the solar rooftop segment. Partially, we are seeing it emerging in the EV space. Then there are spin-offs to this. There is a smart meter segment, which is a very attractive. There is a charging segment, which is very attractive, electric charging segment. So I think the solutions will come. But important thing is that there will have to be a dedicated climate financiers, and there will have to be an effort to create an ecosystem through collaboration.
Very, very helpful, Manish. I think that's a good overview of what you see as the necessary building blocks to keep this chain of financing going.
Yeah.
On that note, Biswarup, if I can request you to share your perspective. We've spoken about the challenges for just mainstream debt coming in. Manish has commented on the kind of partnerships that seem to be necessary, to facilitate financing. And given your track record and your experience in doing blended finance structures, you spoke about some of those interesting initiatives. If you could elaborate on that and tell us what you see as use cases, and also if you've seen some good examples of this implemented in the climate tech space, that would be very interesting.
Thank you. Thank you, Mama, for this question. I think my fellow panelist earlier raised some very critical and valuable points in terms of when we talk about blended finance, of course, we talk on the assumption that this is a kind of a temporary kind of an arrangement until the time the entity or the enterprise really becomes capable of attracting the mainstream debt or the equity investments. So yeah, I really don't know to what extent really blended finance instruments can go to solve the problems of the enterprises that Jayant also mentioned about, right, in terms of the gap in both debt financing and the equity financing, and this huge gap in the equity financing that enterprises face between 3 to 50 million kind of size. Right? But of late, I think blended financing instrument is catching up, and it's been primarily dominated by the DFIs and the multilaterals so far, but private philanthropy is also getting into that space of blended finance because it sees a lot of leverage and then the ecosystem level of support that's required to really catalyze or take forward that market. But just to give a kind of broad brush of the blended finance, I see if you look into last, say, especially after financing for SDGs, discussion of attracting more and more private capital and how philanthropic or concessional money or grant money can help do that. So that space really picked up, and especially when you talk about the blended financing overall scenario. If you look at the blended financing, few of the sectors, like say for example energy and agriculture, and to an extent fintech, or have received some sort of support, right? So even in energy also, it's little bit of a lopsided and skewed, I would say, at this point in time. So the technologies that have received major attention are the mature technologies in around solar rooftops and solar, especially around solar, I would say, because if you look into other sectors, like say for example carbon capture and storing, or say windmills, it hasn't received that much of kind of blended finance support, right? Like solar has received. And again, one is, of course, the skew within the entire energy space, and within entire energy space, you have a skew towards particular technology, right? And if you talk about this, and if you further break it down, there is again further kind of layers that comes across. So one is what blended finance instruments so far have been able to majorly achieve is majorly for the large scale utilities and deployments in the solar sector, right? So if you break it further down, what Abhishek, Jayant, and Manish, Tata Cleantech are trying to do, they are trying to get into more kind of a niche space where decentralization, the role of decentralization comes into play. So, and it becomes even more interesting in terms of the blended finance instruments, how they can really be, because for the large scale one, if you look into the blended finance kind of capital flow, it has been majorly direct kind of investment. So 50% of the investment has been either in form of junior equity or concessional equity, right? If you look into other forms like de-risking or risk assurance or risk mitigation or technical assistance, it has been the allocation hasn't been uniform across the pie in that sense. So yeah, so decentralization again, and the kind of client segment that we are talking about, it makes it very interesting to see what kind of instrument can really be impactful and effective over period of time. So I think I really like one point what Manish highlighted, and blended finance solutions require a lot of collaboration and partnerships. So just to give you an example, like recently after COVID struck, and most of the African as well as in global South, most of the enterprises which are trying to survive in the DRE space, which is again very a tough space, was severely impacted by COVID, and many of them were virtually were threatened to be out of business very soon. So, in fact, recently Energy Access Relief Fund was established, and which pulled in around 68 million USD of capital from various sources, right? And to just give, and it's a partnership of 16 different entities. So all philanthropies you name, major philanthropies, you talk about the World Bank, you talk about IFC, you talk about major philanthropies, you talk about major capital private player. So they participated, pulled in together to create this. But we have been in the process of designing this, and it has not been an easy journey, because there are a lot of expectation of different players. You can imagine, and you have to navigate. You have the philanthropic capital trying to balance it with social impact and social outcomes, right? But you have commercial investors as well looking at preserving their capital, which they should be doing at the end of the day. So it's not an easy kind of negotiation between different parties, and it takes a lot of patience, time, effort, and energy to build this kind of blended financing structure. That's what we are also increasingly realizing, because it's not a single foundation's job, but it needs unprecedented collaboration among different parties, right, to bring it together. Maybe I'll pause here. I think this is something which is very important. For Indian market also, there are opportunities. There are studies who says that you have 300 million of blended financing plus opportunity till 2030 in energy space, which can mobilize 1 trillion USD of mainstream private capital. But to really establish or to create those kind of facilities, it requires effort, collaboration, and time and patience as well. I think what's important is to bring different players and stakeholders on a common platform to talk through it and, and see where exactly what kind of capital can be strategically deployed to make it, to really see that, it is relevant to the enterprises that for whom we are seeking kind of growth.
Thanks, Visrup. So I think maybe on that note and kind of putting on a bit of a solutioning hat, if I can request, Jayan and Manish after that to comment on what approaches might work. We've spoken about the need for collaboration to deliver some of these blended finance structures. What approaches to your mind have worked? So if I can draw a parallel again to my known world, which is more on the financial inclusion side, for instance, we've seen success where larger institutions have been able to rely on partners who they feel understand the segment rather than try to do it all themselves. I think where that trust and that confidence builds in, the process is a little easier to enable the flow of debt. And the emergence of specialists in some of these segments. I think these are 2-3 things which, in terms of market infrastructure would seem to help. But keen to hear your views, Dan.
Sure, Bama. And it's a tricky one, as I think Vishwarup was also trying to say. And it's not just tricky because you're trying to get a lot of people together. It's tricky because you need to know which tool to use, right? I'll give an example. If you take energy access, there are certain segments which make money. And MFIs also fund them, and they are able to get their money back at the rates they expect. But there are other segments where people say, hey, if I don't have capital which is equivalent of 0% dollar terms pricing, I am not viable, right? And they will not say it outright, they will say it in indirect ways, right? So then are you looking at subsidization, which is lifelong? Or so what are we trying to do? So there are instruments we have seen working which are very helpful for new technology or new business model to work out. It need not only be coming from philanthropes. There are government pools also for that. There are equities also cross-used for that, right? Debt is definitely the wrong thing to use for it. But once you prove that your unit economics work, right, then the next stage starts. And that's where the thing becomes interesting, right? If you're saying that, hey, you're ready to scale, now, am I trying to solve for risk pooling? Meaning, if I aggregate 20,000 granular items, contracts, am I risk pooling or ensuring risk in that? Is that risk pooling sufficient to move the needle for the mainstream lending market, right? Those two things have to be answered. What we've seen is there are large risk pools announced in, let's say, energy efficiency, which have not really moved the market because maybe the gap was in demand, right? So are we solving for technology proving? Are we solving for demand, which is awareness or capability building? Or are we solving for risk mitigation? So that's on one side. On the other side, is it really subsidization when I tell someone that, hey, if it's a long duration asset, you need to fund it. You want India to transition its technology choice or energy choice. You need to fund it at a rate of return, which is viable. You cannot use a rate of return used for new to credit small ticket loans and apply it to a SME rooftop solar project, because then you are extracting excess value out of that, and therefore that reduces the attractiveness to the end customer, right? So I am not sure whether it's really blended finance in the sense of subsidizing. We are only saying that if we need to deploy $1 billion to deploy vehicles or $1 billion to deploy rooftop solar, and that $1 billion expects returns which are more equity-like or more bottom-up pyramid new to credit-like, there is a mismatch, right? So if an investor sits on the table and says, for my $1 billion, get me 16% in INR in rupee terms, won't happen if you're trying to do asset deployment. Then if you go to a philanthrope and say, hey, can you please subsidize this? Are you really subsidizing the end customer, or are you subsidizing this investor who is sitting with this sky-high investment? So I think what works is, if you're able to figure out what's needed to solve for this. So what do you need for water today? What do you need for charging networks today? What do you need for rooftop solar today are different. And once you start seeing the difference and you say, hey, I want transition to happen, then you start helping people to on those lines. And we have consumed some of these products, we have given a pass to some of these products because they were not the right tools.
Understand. And Manish, in your opinion, if you kind of hear these comments, who do you think are key players who can kind of come in and provide that perspective, or be players who can kind of bring different parties together? Whose role do you really think that is, as an enabler or a facilitator to maybe accelerate some of the work that's happening on the blended finance side?
Sure. So I agree with the earlier discussions, what Jayant has said, that more than the subsidy, we have to think about risk sharing. Because, subsidies can get lost here and there. Subsidies for whom that can get very nebulous. But I think if we really have to see that the sector scales up, then the important thing is risk sharing in a proper way. And once that happens, then, and a scale comes, then a lot of virtuous things happen by themselves. It goes into a virtuous cycle where the contracts improve, the technology improves, and then the sector takes off. Then the mainstream financials come. So now the question is that who should be taking the lead? That is what you asked. So in my view, the lead will have to be taken by someone who are close to the market and who understand the market the best. The challenge here is that different players understand different aspects of the market. So let me give you an example. Suppose I have to fund an electric vehicle. The challenge is that electric vehicle has got a very high upfront cost. Okay, but the running cost is very low, and the total cost of ownership is actually maybe more competitive, at least after the subsidy, than the ICE vehicle. Okay. The challenge is that the financier will not have confidence on the operating efficiency of that vehicle because that has come to the market for the first time. So the manufacturer and the financier will have to collaborate. One kind of collaboration can be that manufacturer can agree to give some kind of a first loss guarantee, just an example. And on the basis of that, the lender can give loan. And it will have to be a long-term loan because, short-term it will not work. Because the end buyer will also see whether he is saving his day-to-day cost, which will include the cost of financing and the repayments. This may also not be enough, But fortunately, there is a huge pool of money through multilateral development institutions, through other climate investors, who are also willing to look at the first loss guarantee products. So if these three parties come together, some kind of a first loss is given by the manufacturer, some kind of a first loss is given by the multilateral development institution, then automatically the risk, the risk premium which can be charged by the climate investor will come down. The climate financier will come down. So that can make a sustainable model. So this is just one example. Now, as Jen said, each segment will require a different solution. But we go back to our last point that ultimately it is about collaboration, and collaboration will have to be started from someone who is close to the market.
Agree.
Yeah.
Just switching gears, I think, and commenting a little bit on the applicability or access to structured debt for some of these markets. Just to go through a minute of some commentary in terms of what we've seen. I think we've had Climate Bonds Initiative report on overall capital market financing trends that have happened. Broadly sustainable debt classified under green bonds, sustainable bonds, social bonds. And I think of this, the green bond market is perhaps the largest, and while others seem to be growing in size. I think in India, we've seen outcome-driven, end-use specific bonds which have been issued. I think, many of us in this group have probably worked on these transactions, delivered them. Interestingly, we've also seen the use of social impact bonds in areas such as public healthcare, education, which also uses a combination of concessional finance. We've seen recently green bond issuances over the last few years, mainly by financial institutions, which raise funds for renewable energy, waste management, and so on. Some of our clients who are smaller financial institutions have issued green bonds, which are directed towards climate smart agriculture. And we've heard of programs by organizations such as the USDFC, USAID, and many, many others on blended finance programs, which are targeted towards goals such as gender lens investing, furthering financial inclusion, and so on. I was recently looking at the issuance of bonds that the Axis Bank did, which was a US $600 million overseas, 81 sustainable bond issuance under the ESG category. Very, very interesting, I thought. Which is listed on the India International Exchange on the Green platform as well as the NSE International Exchange. And we've spoken about the NEEF fund initiative as well. So the kind of structures that we've seen work, at least in the financial inclusion space, are structures which bring in partial guarantees, as we just spoke about, from either a higher rated institution or a DFI or a fund vehicle which has co-investment or a subordinated investment layer providing credit support. But very importantly, in all of these initiatives, we've seen the role of organizations which have built credibility in terms of evaluation, assessment of the underlying entities, able to sort of provide some skin in the game to back that conviction as well. A couple of applications of structured products that I saw also was the recent trend of increasing solar bonds. I think in the US market, which finances distributed solar. I'm sure Giant will have interesting insights on that. Which is basically backed by loans which are given to homeowners for solar installations and are repaid from the savings they have in energy costs as well as the sale of power to the grid. Another very interesting example we saw was a fintech platform called Solfacil in Brazil, which is basically a platform that funds against solar installations and uses capital markets to do that. Some interesting questions we've been thinking about is, can fintech players, and I think we had a brief mention of that, can fintech players extend loans for purchase of units that basically have these kind of end uses using transaction data, because there's a lot of usage of tech now in delivering these solutions. Is that a possible way to catalyze acceptance and usage of these products? So that was another interesting thought that we had. Just to kind of go across to everyone to get a sense of, and Manish would love to start with you. Which particular segments do you think have greater amenability to using mainstream debt products or structured debt products? Where do you see that scale and maturity having come in? And maybe scalability to allow smaller entities to come in through some of the programs you spoke about, but really access commercial investors to a greater extent as well. And then would love to hear from, I think, Biswa, Giant and Abhishek as well. And then maybe we can open up for Q&A.
Sure. So clearly, in terms of segments, we have seen that solar has made a good progress. So I think solar rooftop has a huge potential to attract money now. The challenge there is that the discoms sometimes don't support the SME customers because they tend to lose those customers. So I think the challenge is more from the regulatory side. As far as technology is concerned, there is no challenge. As far as economics is concerned, there is no challenge. So today, I think India has a solar rooftop installation of around, I think, 4 gigawatts. But the potential is multiple times of this. Once we get the things in order as far as the regulations are concerned on the net metering, on gross metering, and so on and so forth. Mobility, I think, has a huge potential. And I think already it has taken off, and we are going to see much more activities going forward. But there, clearly we are there as far as technology is concerned. Again, government has supported in the form of subsidies. So there I see exponential rise in all segments, in terms of purchase of vehicle, in terms of ecosystem for batteries, in terms of charging infrastructure and so on and so forth. Then waste management has a huge potential. And I think it is something which should have happened day before yesterday, because the kind of waste we are generating is mind-boggling. I think their regulations have to take the right steps. Government has to take the right steps. That technology is there. Now we have got technology to convert all this bio-waste into gas within the complex of the society itself. And that can be a game changer. So I think waste management, huge potential, but something needs to be done on the regulation side. In terms of industrial energy efficiency and in terms of circular economy, I think the technology is there. Today we have a very good technology for wastewater discharge, zero wastewater discharge, desalination and all. I think that will also pick up. This will be driven more by the technology because industries are subject to stringent regulations. They are cost conscious. I think that segment is quite attractive. Going forward, I think even agriculture has a huge potential. In India, the lowest hanging fruit is, the land of all the farmers, and India does have a scheme for that, which is called the Kusum scheme, where it is possible to generate electricity on the land itself, where the farming is happening, and that can be a game changer in terms of the fact that Discom lose so much of revenue for supplying zero cost energy to the farmers. So I think these are the segments which are immediately ready. I'm sure there are more, but then this is what comes to my mind.
Excellent. I wonder if we've run out of time because I see a lot of other people who are now with us here. But if there are any quick closing comments from Jayant, Abhishek, Biswa, any of you would like to kind of add, and then maybe we can close.
I just wanted to quickly jump in and endorse one of the point of views of Jayant. I think what's extremely crucial is to keep in mind it's not about particular technology, but it's about solving the problem, right? Solving the problem of the end user. So that's until and unless we are able to reach and focus there, it's very difficult, in terms of scalability or whatever you talk about, right? And the other point that's been mentioned, so if you are really solving that problem, right, then you can look into those kind of partnerships which really can help reach those solutions to the end consumer or customer. So we don't see climate and development really in conflict. I think this has to be read in conjunction. It's beyond the climate, right, carbon reduction goals that we are talking about. We should also bring in front the kind of impact that we are having on people beyond the planet as well. Thank you.
That's a great closing comment, Biswa. And on that note, I'll hand over to Shreya to take us through the rest.
Thank you. Thank you so much, Bama, for your brilliant moderation. A big thanks to all the panel members